Breaking news is we've just learned that there's an additional 217% more households that are currently behind on their mortgage, despite what leading industry data providers are suggesting, like Black Knight. So I have our community expert in all things mortgages and all things delinquencies, Melody Wright, here with us to help try to explain what the heck is going on. And if you guys like what she has to say, do not forget to go to her Substack, M3 Melody. This is a great, I'm really jealous of your writing. Your writing is absolutely exceptional, value-packed newsletters. You guys go here, subscribe to that. Also, don't forget she has her own YouTube channel, Melody Wright, as well as being a member on DNN. First and foremost, Melody, before we dig in and before we go under the hood and we show the viewers what's going on, how are you today?
I'm doing well, Travis. How are you doing? We just got new home sales, so that was a very interesting piece of data. So I'm a little excited today, Travis.
Yeah, good. It's important to be excited. So I'm going to jump right in, Melody, to show the viewers Black Knight, which is the leading data provider. Here's Black Knight's Mortgage Monitor Report, September 2024. And again, the bad thing about all this, Melody, is if people are using this like industry professionals and they're using like lies and fraudulent data, then all they're doing is spreading the misinformation. Now, the first thing though, let's look at Black Knight. Again, rosy colored lenses. Even with these rosy color lenses, look at month over month foreclosure starts are up, according to this, 32.3%. So again, even though they are rosy colored, that's a pretty massive jump month over month. In addition to that, I wanted to show the viewers once again foreclosure inventory and starts. And I highlighted 2010 and 2011 because that's really when the foreclosure inventory started to hit the market. We really didn't get foreclosure inventory until after the recession and until after home prices already started going down. Remember, we had massive price decline, a little bit in 2007, but a lot of it was in 2008 and into 2009. So the price decline happened and recession happened prior to the foreclosure inventory. And you can see that here in this chart. Home affordability, Melody, here's the national payment to income ratio. Right now we're sitting at 34.3%. That's as high as it's been since about 1986. And that's only counting principal and interest. So it's actually higher than that when we count taxes and insurance that have been absolutely skyrocketing. But I also wanted to take a moment to pause real quick here. Even though the payment is at 1986 levels, the PE ratio, or the price to earnings ratio, is almost double. So back during this time, the PE ratio was about 4, and right now it's close to 8. So the prices are parabolic when we compare what the prices were in the 70s and 80s. Talking about home price decline fueling foreclosures and delinquencies, here's a map that Black Knight made right here of the 1-month home price change. And you guys can see several metro areas, and these are just the top metro areas, are experiencing a month over month price decline. And so I've highlighted here on the right side, probably the metro areas that are the biggest at risk of additional delinquencies, starting at Jacksonville, Florida, which is leading with month over month decline at 0.43%. And then the next is Tampa and then Orlando. So Melody, the first 3 top metro areas of price decline are all in Florida. And then we have Austin and then another Florida, which is Miami, San Antonio, Texas. You're leading so far as the month over month price decline so far.
So far, yes.
Melody, can you explain to the viewers, and is it fair to say that generally, at least based on our experience with just a couple decades, right? Is it fair to say that we really don't get foreclosure inventory until after recession and until after price decline? Is that fair to say? Why or why not?
Yeah, I think that's fair to say. I think that, honestly, though, we should also, it can be very confusing looking at that historical data because a lot of the banks went on hold. They were dictated to go on hold because of their bad practices. And so that, that time period when all that was going on around 2010, 2011, you don't really know how much of that inventory was being counted because of that hold. But to your point, that's 2010 and 2011. And so in essence, just like we don't see unemployment claims really peak until after recession has already started, we're not going to see foreclosures start to tick up until, we see continued pain in the economy, which we're starting to see with accelerated layoffs and bankruptcy.
Yeah, and Melody, it's fair to say that foreclosure is not a good indicator of recession. Is that correct?
No, not at all. I mean, not at all. I mean, that's like you say, Travis. I mean, to us, I guess it's probably self-evident, but foreclosures come after because what happens? You lose your job, right? You can't pay your mortgage. For people like you and me, you might have some things you can do. You might have something you can sell. You might be able to go refinance your home, and it will buy you some more time. But then you run out of time, and I'm seeing this in my client books right now, Travis. Overnight, we increased our foreclosures by 30% as well. And so what's also happening in the background is that you've had a lot of pain in the system. You know, like the FHA, we see it all over the FHA, but it just takes time with all of these programs. VA foreclosures are still on hold. They'll be on hold till December. And effectively, Fannie and Freddie foreclosures are on hold because they just launched this new loan modification targeting a 20% payment reduction. But, that's not working for everybody. In my books, I saw a denial because when they ran the calculations, because of property taxes and insurance, which you just mentioned, their original payment, the new payment for the loan mod was more than their original payment because of taxes and insurance. So foreclosures aren't going to happen before a recession. They are a lagging indicator because that's when people run out of options. Now, the fact that we've had so much investor speculation, we might see more initially, but especially, with those folks, those investors that just decided to walk away, they're just going to walk away. And we're seeing that number, or the no contact number, go up in the FHA population. And so that's probably a lot of what we're seeing right now, and kind of early middle and lower class folks that have just been completely crushed by inflation. That's kind of the population of default right now. We have not even begun sort of the prime borrower default wave, which was the default wave. It wasn't subprime. The default wave that, sort of peaked in 2011, that was prime borrowers.
It's hard for people to understand what's going on, especially if the industry professionals, Melody, are using data from a data provider that is hiding 217% of the delinquencies. And so now I want to move on, and I want to look at the HUD survey, because basically we're talking about the establishment versus the household. And what have we learned from the job market? Well, what we learned from the job market is we can't trust the establishment survey, and that the household survey is much more accurate. How do we know that? 818,000 job revisions. So we know that the establishment surveys are always wrong. And so I'm going to take you guys into HUD. But before I do that, let me take you guys back into Black Knight so we can remember how many households they're reporting as behind. I highlighted right here, and it's a little bit hard to see, but Black Knight is saying as of July that there's 1.99 million households behind. So I want you guys to remember that. And then I also highlighted something up here. I also want you guys to remember that the total amount of homeowners that were behind in 2009 was 7.6 million, because that's going to be important to remember for later. Here's the HUD survey. This is the Housing Market Indicator monthly update. This is for August of 2024. And there's some very revealing information in here. I want to show you guys how we calculated the math, because I don't do this for you. We have to do this ourselves. Again, this is HUD. This is not the census. When I show you guys the census, you guys are your minds are going to be blown. HUD is saying that they're taking estimates from approximately 82.5 million homes. And for rental information, they're doing estimates based on 45.99 million. So when we look at the actual delinquency rates, which is 5.53%, you guys see that right here, behind on mortgage, 5.53%. I also highlighted rentals. Behind on rental payments is 12.3%. But again, here's what this equals. 5.53% of 82 million, that's 4.56 million households. Again, Black Knight is saying 1.99 million. This is saying 4.56 million. The difference is 128%. That's just a survey. The household survey from HUD is saying a delinquency rate of 5.53% with 4.56 million people behind. Also, just real quick, I did the math here. There's also 5.65 million renter households that are also behind. So Melody, the difference again is 2.56 million households. So a minimum, and I'm going to show the viewers something even crazier here in a minute, but at minimum, when we compare Black Knight to HUD, again, they're missing 2.56 million households. That is a 128% difference. My question to you, Melody, is do you think that Black Knight is intentionally holding back the data to make the housing market appear stronger than what it actually is?
I don't know if they're holding it back, Travis, or if it's just they don't have, certain servicers on their platform, like these, they're called specialty servicers. That those are the ones that do a lot of the default. A lot of your bigger companies will actually sometimes sub-service out to them. So I'm not exactly sure that I don't know if they're intentionally hiding it. I do know that either they don't understand the space. They don't understand how this works. And whether that's intentional or they're actually trying to mislead, it's hard to say. Like if you look at an example, today's headline from Bloomberg says that there's a refinancing wave. They took that from the applications that have ticked up for refinance. However, when you look in context, that is nothing. It's not even as high as it was back during the GFC. You have to go back to the early 2000s. And so, that's very misleading, in my opinion, for them to say this refinancing wave as if it's already happened too, right? And we know applications are not closed loans. We don't know what that pull-through rate is actually even going to be on those applications. And so are they lying? Are they intentionally misleading? I don't know, but the result is the same. Our community is not informed by these sources.
Right. I mean, are you at least suspicious?
I am suspicious because, ICE owns Black Knight. ICE owns the New York Stock Exchange. I mean, there's just a lot of reasons that all of their incentives are out there to keep us unaware of what's actually going on.
Yeah, honestly, I'll say it, Melody. I 100% think they are doing that on purpose, because if they're missing 128% of the data and the real delinquency rate is almost 2% higher than what they're saying, then yeah, they're manipulating the data to make it appear that the housing market is stronger than it actually is, because that suits their narrative and that narrative benefits their bottom line. And that's what I think. But I want to take us to something else that's very interesting. I mean, there's all these data manipulation games, multiple data providers. I'm going to stick with HUD. I'm going to look at another thing from HUD that's going to go into the FHA stats. So all we're going to do is we're going to look at FHA because I think what you guys are going to see here is extremely revealing. Take a look. FHA single family loan performance trends, because there's a few things that are, pretty revealing here that I think it's really good to look at to tie into the qualified mortgage failures, or really the industry changing the guidelines. First of all, as of right now, this is saying that the delinquency rate for FHA is 12.29%. I believe, Melody, during the GFC in 2009, and correct me if I'm wrong, wasn't it more like 13% in 2009? Is that correct?
Yeah, 13 to 14%.
FHA is very close, very, very close to 2009 levels. But what I also want you guys to see is I want to show you something that I found here, which is basically 2018 and 2019. Now, what you guys are looking at here is a total cohort of loans, which basically means it's categorizing what year the loan was originated compared to that delinquency. And so I've highlighted 2018 and 2019 because what's very interesting is the delinquency rate on those loans, even though it's only accounting for about 10%, the delinquency rate is 19%. Melody, in 2019, delinquency rate is 19%. In 2018, it was 17.86%. So it's fair to say that that year so far has a higher delinquency than what we have right now. So right before lockdowns, FHA at least, and it's very difficult to find conventional mortgage data, had a worse delinquency crisis brewing than the GFC. And I'm wondering, Melody, do you think that these numbers, the 2018 and 2019 numbers, have anything to do with this report from the CFPB? This is a Bureau of Consumer Financial Protection Bureau. Here's the docket number if anyone wants to see. This is about an 85-page legal document. And I've highlighted a couple of things here that I think are pretty important. Okay, so based on 2018 data, remember 2018 has the highest rate of delinquency, guys. Highest rate of delinquency. Let's see what this says. Based on 2018 data, the Bureau estimates that as a result of general qualified mortgage loan definitions, 43% DTI limit, which by the way, they raised that. It's supposed to be 36, but they raised it. And even though they raised it to 43, there was still violations. Approximately 957,000 loans, or 16% of loans closed in 2018, were in violation, guys, a violation of debt to income ratio. Now, instead of the Bureau and government agencies fining these companies, they just changed the rules. So they just passed that on to the consumers. I just want you guys to think about that for a minute. They protected the banks, they put that on you, and now those borrowers, and we just saw the data, are suffering. Based on 2018 data, the Bureau estimates in the general QM proposal that 943,000 high debt to income ratio, most of this was actually good credit conventional loans, would fall outside of the QM definitions if there is no change to the general QM loan definition. So again, they just changed the definition, Melody, and completely devastated those borrowers. Melody, what are your thoughts on all of that?
Well, 2 points I really want to make. One is a lot of people don't understand that FHA has really doubled since the GFC. It was pretty ugly out there after the GFC in terms of mortgage lending. And so they really had to push these government programs because your banks pulled back. They didn't want to do private loans and they didn't want to do government because they know when you do those government loans, that claim payout rate is not good. And so those government loans are very risky. And so the banks figured that out and they're like, nope, we're done. So the non-banks came in, but of course they don't have deposits. But the non-banks came in to do those FHA loans because the banks said no. And so that product got pushed. And so it really took the place of that kind of private speculation that happened last time. And that's why we say it is subprime. So that's very important. The other thing that I can tell you is that I saw this in all my mortgage books. You saw delinquency ticking up from loans originated in 2018. We have borrowers still in my client books that should have never gotten a loan in 2018. Never. They have been in some form of delinquency since then. Always. And every month they're trying to catch up. They get behind 3 months, they go. So I absolutely agree with you that things were starting to really deteriorate in the housing market. And if it hadn't been for the Fed buying those mortgage-backed securities and lowering those interest rates so much that everybody could refi, I think we would have already been in a kind of GFC style crisis.
That's exactly the point I was trying to make. I mean, do you think that, based on those numbers we just looked at, I mean, 20%, roughly 20% delinquency in 2018, 2019. I mean, do you think that delinquency crisis was potentially worse than the GFC? I mean, you talked about the total number of loans like it's double, but I mean, come on, Melody. I mean,
I think this is much worse, Travis. This is much worse because credit scores are inflated. We didn't instead of looking at what students owed, we looked at a $250 a month payment. I mean, we really stopped looking at true ability to repay and just what they could afford as a payment. But when you're looking at just payment, you're assuming they're always going to have a job. And that's not how that works. Yep. And we are absolutely, people may say that, unemployment is still quite low. The fact is, though, it's been going up. And so the assumption out there that everybody can pay that payment is a faulty assumption, even if the numbers are small.
Yeah, I mean, and again, they're hiding the data. And I want to show the viewers now, Melody, the census. Okay, so we showed you guys Black Knight. We showed you HUD, the households HUD survey. But I'm going to show you the census survey now because we found an extra 4.3 million households behind. Again, we found an extra, from what Black Knight is saying, an extra 4.3 million households behind. Take a look. This is an Excel. Again, this is from the Census Bureau. Melody actually sent this to me and my mind was blown, but you guys can see right now, households currently caught up on mortgage. We have 6.355 million. You guys see that right here. Okay, this is a household survey. 6.355 million, not people, households are behind on their mortgage. That 2.35 million represents an increase over Black Knight of 217%. So we just found 217% more households, more data that shows people are behind on their mortgage. And so let me ask you this next question, Melody. Who should we lean on more to figure out what's going on? Should we trust the establishment, Black Knight, ATTOM, or do we trust the actual households? Do we trust Main Street? Do we trust the people? Who do we trust, Melody?
Yeah, I think it's, there's not a lot of people to trust out there, but we're not going to trust the industry insiders when it comes to what's the true picture of the American consumer. And, we also know that some of the older establishment surveys from, the BLS and others have a very low response rate. What I found very interesting about this survey, Travis, is its response rate is going up. Now, I wonder, is that because when you're in trouble, you want to tell somebody about it, maybe, if it's the government, because maybe you want some help. So contrary to all of our other surveys out there that people have stopped responding to, this one is growing. This is a newer series. Yeah. And so I think we have to look at this survey because this very much, you guys know that I talk about the silent depression. That was a term Emil Kalinowski came up with, but we have been in a depression. It's just the media refuses to acknowledge it. And they've done all kinds of fancy math and fancy, statistical tricks. And I remember when I took college stats or statistics, what you realize when you walk out of that class is you could find a statistic to support just about anything. And so, they do some fancy footwork and they really try to convince us that we are living in a much better economy because they know our expectations about the economy are what drive consumption. Because if you think that the economy is going into the, you're not going to be spending on your credit card as much as if you think everything's this Goldilocks out there.
And just to recap for the viewers, okay, we showed you Black Knight. Black Knight has, let's just round up. We'll do them a favor, even though they're not doing us a favor. Black Knight has 2 million households behind. HUD, Housing and Urban Development, also a government agency, right, has 4.5 million. The Census Bureau has 6.3 million. Massive, massive, massive discrepancies. And Melody, let me ask you this. I mean, honestly, and I know you don't like putting anyone down. I really admire that about you. If, let's just say, let's just assume that the households are right. Americans know what's going on with themselves. Let's just assume that. And let's assume 6.3 really are behind and Black Knight really is only using 2 million. Isn't it fair to say that if you're an industry professional and all you're using is Black Knight data to explain to people what's going on with delinquencies, isn't it fair to say that if you're doing that, all you're doing is spreading misinformation?
You're making the best of the information you have. And let me just tell you something really funny. When you look at those Black Knight schedules, they do a little line for delinquency of, I think, pre-2006. They don't show the whole historical series. And I think what's funny about everybody talking about how historically low foreclosures are right now, you can go back using Black Knight data and pull it. And essentially, it is exactly the same level as August of 2006 because we are in early innings, just like you started this video off. Foreclosures don't lead, they lag. And so, I do think they're trying to present the rosiest picture out there. And I'll give you an anecdote. I was talking to one of my clients and I was presenting that delinquency by vintage year that I shared with you, kind of similar to that cohort schedule. And what that was showing is that 23 and 24 in terms of had the largest share of delinquency, and you don't want to see early delinquency. That is signs of trouble. And my client said to me, why, I haven't seen this data anywhere. Why isn't anyone talking about this? Well, I have that data because I have access to the back-end database. They're not putting that in their report. Now, I don't know, is that because they're trying to paint a rosy picture or they truly just don't understand the mortgage market? Because, my expertise came from learning it in times of crisis. And I think a lot of those people have left the industry. And so, I do believe there is definitely some strong arming and to kind of lead people to certain trough of water. But yeah, but it's not, here's the ultimate thing that we want to say to everybody is stop looking at it. It's not telling you the real picture of what's going on. And maybe they themselves are also just delusional.
I mean, look at all the digging that we had to do. I mean, I've been digging for two and a half years, and I just now found the census survey, and I'm going to show the
And we're
viewers
from
something.
within the industry, right?
That, yeah.
You and I, of all people, would know better how to find this stuff than your regular person on the street. And we're from the industry, and it's taken us all this time to find these things.
It has. I mean, it's crazy. I just wanted to recap. Remember at the beginning of the video, I told you guys to remember in 2009, according to Black Knight, they had a total of 7.6 million households behind. Okay. I told you guys, remember 7.6 million. According to the Census Bureau, we have 6.3. Instead of like, yeah, good job, guys. Like you guys dug deep. You found all this stuff, right, with the census data and HUD. Instead of that, from our own colleagues and from our own peers, they're like, doomers. You've been talking about this for 2 years. Ain't nothing happened. Everything is fine. And I'm like, well, it's not 2018 anymore, you crazy psychopaths. We have a very toxic housing market. Not only is the housing market toxic, so is the data reporting agencies. I mean, the toxicity and the manipulation and not only that, I mean, the apathy as well. I mean, more people should care about this. Melody, how can we end this video with everything that we just uncovered? Black Knight, HUD, Census Bureau, progressively worse and worse and worse as we get away from the industries, right? Take all of the stuff that we learned in this video and dice that up. And how do you take all of that and condense that into some type of hope or ability to hedge against challenges?
Awareness. I mean, awareness is so important, Travis. If you're not aware of what's really going on, how can you prepare for it? And you know, look, like you and I, 2 years ago, 3 years ago, we started making very different decisions about our lives because we could see what was coming. That's why we've been talking about it for so long, is because we wanted to give people awareness so they could prepare, so they could do things. They could consolidate households. You know, they could, you know, figure out, save more money, you know, all of those, spend less, pay down their debt, because those credit card rates are crushing people. And because we know, and that's why we've been saying it. And that's, if you have awareness, if you first have to understand a problem before you can start to solve it. And so now you have more information. Now you understand the true picture of consumer health out there. Now is when you have to start making different decisions that are going to protect you during what's going to be a really kind of not great time, guys. But in that, we can, you know, we can come together as a community and help one another. And that, you know, my message of hope, though, is that on the other side of this, I believe that we're going to have affordability for shelter again. And we're going to have to go through some pain to get there. And none of us want that pain. Like, I don't want anyone, I don't care how big of a jerk they are. I got to be honest with you. I don't want them to lose everything. That's not, you know, because typically those bigger jerks, you know what they do? They end their lives. I mean, that's the unfortunate thing about, you know, what we saw during the GFC were a ton of suicides. We've already seen, you know, deaths of despair increase. That's another reason why I think we've been in a silent depression. And so a lot of times what happens, and, you know, it's not necessarily that person, it's their family that's left behind. It's young children that are left behind, having to fend for themselves. And so, you know, there is hope because there's hope in our community. And the awareness gives us a weapon or a tool to really protect ourselves with as these things start to unfold.
100%. Step one, awareness. Step two, action. And I tell people all the time, Melody, I've told you this multiple times. In case you guys don't know, I mean, I lost everything, right? During the GFC, I lost everything. I had a foreclosure, bankruptcy, repo, a 6-digit tax lien that followed me around for 9 years. I had to run out the statute of limitations at the IRS because they got to extend the time that they could collect for me because the bankruptcy extended that for them. But needless to say, if I would have just changed my life 6 months before I lost everything, I really believe I would be a millionaire right now. But instead, I lost big. And what we're saying is, hey, it's okay to lose small, all right? Just don't lose big. And I lost big because I kept my head in the sand. And again, if I would have redone my whole life, I would have lost small. It would have been painful, but it would have been small. And instead, Melody, 11 years of depression. I don't even know how I made it out of that. I mean, it was so bad. But, you know, I think what we're doing here is really giving people additional perspective. And all we're saying is just pump your brakes, save your money. That's it. I mean, are we really that bad at people? I mean, save your money. I mean, oh, shame on you. Melody, I like what we're doing here. I think what we're doing is again, the perspective that I didn't have when I lost everything. Like I didn't know back then that they were hiding information and lying to me. And I didn't think that we couldn't trust the Federal Reserve. Well, I know now that we can't, right? So again, awareness. Your awareness helps your actions. It helps govern your actions. And I think that again, though, when we look at apathy, I think step 2 is just as important. Step 1, awareness, but that's step 2, man.
Mm-hmm.
I think that may be a bigger problem, Melody. I think that apathy, how big a problem do you think the lack of initiative is for consumers to change?
It's huge. It's not until pain. And I can tell you, amongst my friends and family, I've been warning. I've been, most of them think I'm crazy, like the rest of the world. But, I've been warning them, warning. And they've been coming to me recently. One who had done a lot of jobs that when people have a lot of money, they're going to pay for, private yoga coach, social media manager, all that has an Airbnb host. Well, Airbnb host, that ran dry over 1.5 years ago for this person. All those other clients have disappeared. And now this person is going to have to go back and get a service job. And they made a ton of money off of Airbnb during the boom. And I kept telling them, please, please, please change a little bit of your behavior. Save some of this. Don't go to Starbucks every day. And I would just send little annoying messages like, 1 Starbucks a day, that's $1,800 a month. That's the mortgage payment. All of this to say that those little decisions can truly save you a ton of heartache. But there is, it's recency bias. We believe what has been will be, unless you're just wired differently, like either through experience like you or just wired differently, And so, yeah, Travis, the action is so important, and the apathy is massive. When apathy gets met with reality, and that unfortunately for a lot of people, it's going to take that hit in the face, that reality, before they change their action. And hopefully, though, our community is much smarter than that.
I believe it is. Every fiber in my being tells me that our listeners are stronger. And I want to give, I've been battling inflation myself. I'm not a rich person. I mean, I'm struggling saving. In fact, I haven't been able to save. I've been living paycheck to paycheck because I can't save. If you can't save, you're living paycheck to paycheck. And so some of the things that I've done to cut down on my budget has been obviously going out to eat. That's a huge one. Obviously subscriptions. That's a huge one. I just canceled one yesterday, saved another $60. But also what I'm learning is medical. I've actually rearranged my medical. I won't go there with you guys, but maybe you should look into some things. And another thing that I'm combating right now, Melody, electricity. I got a solar generator and some panels. So now I understand how much electricity I'm wasting. And I got to tell you, I probably, if I wasn't, I have, obviously 3 children. So it's not just me, but I honestly think I could cut my electric bill in half if I was just conserving my electricity. Literally, if I was just a responsible adult. And I made sure my children were doing the same, right? I think that we could, I think that a lot of us can save half, maybe, on our electric bills if we just remembered how we used to live back in the 80s.
Oh, yeah.
And 90s, when our parents were like, turn that light off. You don't live in a barn door. You remember that?
Yeah.
Oh, now it's just just keep the lights on and it's LED. It's fine.
I remember in the 4th grade, I won a prize for coming up with a slogan. I said, be like Irv, conserve. Wasn't very clever, but I won a prize. But that, all right, guys, everybody was worried about it.
Be like Irv and conserve.
Conserve.
I wanted to say, to the viewers real quick that Melody and I have set up, if you're interested in helping us, I hate to say this because I was not raised this way, but a GoFundMe account for our trips abroad that we'll be doing all the accounting for. So if you guys want to help us travel around the nation to report back to you guys know how much we love doing the cinema, the drones, and all of that type of stuff. But I got about $30,000 wrapped up into those trips that I've lost on those trips, so I cannot afford it. We have done that GoFundMe. Thank you for doing that, by the way, Melody. The link is in the description if you guys want to help us. If not, that's okay. We understand it's hard times right now. Trust me, or we wouldn't even be setting up a GoFundMe. But if you are interested in helping, the link is below. And other than that, if you guys are out there investing in real estate, you guys already know we wish you luck, and we hope you win.